All right, very excited today. We have the very famous Jerry Parker, the Chairman and Chief Executive Officer of Chesapeake Capital, and famously one of 13 turtle traders, mentored by the legendary systematic traders Richard Dennis and William Eckhoff. Jerry, thank you so much. Really appreciate having you on the show, and wanted to give a special thank you to Mike Carloni, who did a lot to set this up, and Tony Confliti and Tom Basso did a lot of interview prep work to get me ready.
Oh, good. Well, thanks for having me. Those are all good friends, and I'm glad that they brought us together like this, and I'm looking forward to our time together.
Oh, okay, great. You know, one thing we were just curious to hear more about is, can you tell me a little more about Richard Dennis and William Eckhoff and your relationship with these gentlemen?
Well, there's a lot to say. I think that's really one of the biggest secrets about the Turtle program was who are these guys? People want to talk about the rules and the training and the making the 200% per year, but really the one thing that I think gets missed a lot is that these were just genius people. They were amazingly genius and smart, and we were just blown away. You know, you think you're smart, you think you went to college, you got a good degree, and you've done something in life, and you think you're smart. But man, I would just leave the meetings with those guys just like not. This is like people from another planet, just a different type of a person, and they were, great with the systematic trading and the trend following, the math and the computers. They were the very early adopters of, combining math and computers to do back testing and knowing how to look at the markets in the correct way. Bill Eckhart is like was almost a PhD. I think maybe one class or something. For some reason, he didn't get his PhD, but and then Rich was super smart as well. And they were like high school friends, but yeah, just amazingly smart. And Rich had a lot of experience in the trading pits, in the bond market or the grain markets. So it was a combination of being able to do back testing properly with the math and the computer skills that were necessary, and then combining that with the real world trading experience of someone who had actually traded before, not just an egghead or PhD who thinks, oh, I can come up with these ideas in math and these systems to create a great trading strategy. We had both. They had a combination. And so we were learning, here's what the computer says, and here's like the real reality of how the markets work and what you can try to accomplish in the markets. But and they were incredibly generous people and nice people. I mean, just the nicest people you'd ever want to meet. Very generous. And but one of the funny stories was that Rich, and you got to remember, this was in the 80s, not like today where people dress kind of casually usually. And I live in Florida, and no one dresses up in Florida for anything, hardly. So, but back in the 80s, Rich was sort of famous for, not wearing a coat and tie and dressing casually around the office. And so when they decided to do the turtle trading class, we had like a 2-week class where they taught us like 8 hours a day the strategy. I think his secretary chose the one hotel in Chicago where you had to wear a tie. So it was kind of crazy. The Union League Club in Chicago, which I don't think I've been back there since then, but I guess it was this old-fashioned hotel, and they required everyone to wear a coat and tie at all times. So I think Rich was just like shaking his head, like, "How am I wearing a tie?" During this. So that was kind of one of the funny things, but it was a great experience. And like the first day of the class, we're sitting in there, and everyone, like every hour or two, they would just do a coffee break, and everyone would run to the telephones to check on the markets. And we were like, what is this about? I don't understand. Why are they doing this? And then after the class and after we started trading, we're like, oh, we understand totally. We have to know what's going on all the time, and then we didn't have iPhones or the internet. So I guess in some of the restaurants around the Board of Trade, they would have a computer screen running with the quotes. But it was just a complete experience that we learned, not only like, here are the rules, here's how you trade today. It was more like making us equipped for the future as well. So philosophically, understanding how things work, parameters may change over time. Your strategy may evolve a little bit over time, but the real genius was taking these 20 people and equipping them fully for the future, if they were up to the task, basically. Not everyone is going to be good from the very beginning, or like I was pretty slow in the beginning, but I was better in the, planning for the future and making this great experience last my entire career, which I was hell bent on doing, of course.
I know you're a very admittedly competitive man, but I also find you very humble in watching a lot of your interviews. But we're going to ask anyways. What are the personal traits that enabled you to be, what most people consider the most successful of the turtle traders, and widely so?
Well, that's a good question. I'm trying to think of something that could compete with my number one thought, which was, really, you have to believe that what you were taught or what you're coming up with, you have to believe in it to such a strong degree, that you've heard the ideas about you got to be disciplined, you have to have a set of rules, you have to follow these rules. And, but when you live trading and then you start trading and it's going to be your job, I couldn't imagine not having a set of rules. And then you just have to fall in love with them and just be dedicated to them and really believe, initially what Rich and Bill taught us, and then believe it for the future. That, like I said, their stated goal was to teach us not things that would just work in the 80s or now, but things that were going to work for our entire career. So philosophically, the principles of what makes a successful trader, understanding that things change and evolve, they were all about evolving and changing, trust me. But just believing that and dedicating yourself to that mentality that, your goal is to follow the rules, and I believe in these rules, and when things go bad, I'm going to stick with the rules. Maybe I'll change them and improve and evolve a bit, of course. But my core being is that I love trend, I love price, following price. You can't predict the markets where they're going. Rules are superior to discretion, lots of diversification, et cetera, et cetera. So I just never, ever did not believe that. I believed it before I got there, and I believed it ever since. And I was just the type of person who was seeking out things that I can always believe in every element of my life, whether it's diet and fitness, trading, politics, economics. I'm that kind of person who wants that touchstone that I can always come back to, that philosophical core that makes me sleep well at night, even knowing that I'm not doing very well, and even knowing I need to improve, I can do things better. But I remember getting off track once back in the 90s or early 2000s. I kind of got off track what I was believing and how I was trading. And I remember quickly telling myself, don't ever do that again. That's crazy. And really taking a lesson from that. But then I would hear other people say, who had done the exact same thing, the lesson that they took away was, I need to become even more different. I need to get even further away. I didn't go far enough away from what my core beliefs used to be. And so I was very thankful that even though if I made mistakes, I never profited from them. I always had worse performance if I deviated from my core beliefs. And so I quickly was able to get right back in gear with doing things the right way.
That's great. Sorry, this question is the question people, a lot of people are asking that, it's slightly controversial, but we'll ask it. A lot of people are still asking, do the turtle rules still work? And, what the future of trend following. Sorry, it's a bit of a loaded question. I apologize.
No. It's an easy one.
It's
I
just
just got
a little rude. I mean, sorry.
I kind of just got finished saying yes, but yeah, I mean, of course, I think trend following definitely works. I think what we were taught, I have not been able to improve very much. I have not heard people improve on it very much. I listen to a lot of podcasts and a lot of interviews, and I've never been very not as impressed as I was at what I learned from Rich and Bill, and I haven't seen another Rich and Bill type, honestly. Where I would say this is just a human on a different level, especially as it relates to trading. I'm waiting. I'd love to, but no, I think that what they taught us, these core beliefs of how the markets work, how trading works, systematic trading ideas, uh, those things, I haven't been able to improve that at all. Now, the specifics and the parameters and the exact way, we trade with just basically longer term, and we have gone crazy with adding so many markets and stocks and other commodity markets and fixed income ETFs, lots of different currencies now. I traded 25 markets in 1984, maybe 20 to 25. Now we have traded over 300. And that's just me listening to them saying how important diversification was and is. And me saying, well, I'm just going to be insane about it. I'm just going to trade individual stocks and build a portfolio of stocks that are not as correlated as the S&P or whatever. So, yeah, I think a lot of people the turtles still might have a little bit or 50% or 60% of core trend following, but they've gone way off of what they were taught. And I have not, and I am very happy. And I would change in a heartbeat. If I had heard or could have explained to me or figured out on my own something that would make it better, oh my gracious, you gotta understand, I would abandon anything and adopt anything that I thought would improve my performance. But I have not seen that at all. So it works, but you just, basically you have to be longer term than we used to be in the 80s.
Mm. If we just go back a bit, you actually went into some questions I already had. Was if you could just explain quickly the logic of holding over 300. I think you're at 307 positions.
Well, I have three, maybe that's correct on the positions, but in the background, there's probably another 30 or 40 things in my portfolio that I'm flat. I don't have a position in it, but if it's usually because I have this ETF and the positions are known daily. You can look them up daily. I'm smiling because I don't know why I'm doing that, but I usually have some markets that I'm kind of flat as well. So it's over 340, something like that.
Part of that reason is just so that there's nothing you
Oh,
would miss that would have that big outlier move.
oh, well, kind of, but yeah, I didn't answer your question. Sorry.
Okay.
Yeah, so it really is a question of you're trading this strategy that is take small losses and then let profits run. And so take small losses, okay, that makes sense. And that is not necessarily too controversial, I would say. But letting profits run, and now we're getting into it. We're getting into it where it's Jerry versus the world, right? Because I let profits run and almost no one else does. So I'm speaking for the rest of the world here. So maybe I'm overthinking or overstating this, but CTAs have a very difficult time of letting profits run. They like to reduce if it's a profitable trade, I just let it go until the trailing stop gets hit. And I've already said the trailing stop is more long-term now. So my open trade positions in, the big trades like orange juice, cocoa, sugar, short the yen, that's a big downtrend, this year. Short the bonds is a big trade now. I just let those things fluctuate like crazy because my trailing stop is long term. It's far away from the market usually, especially if the market is at all-time highs or all-time lows. I'm being very liberal, letting the trade stay alive and not get out too quickly. And the volatility is increasing sometimes, the correlation is increasing sometimes, and I do nothing, zero. And everyone else, all the CTAs, they're scaling it back if the volatility gets to be too high. If they notice the correlations are increasing in some of the markets or sectors, they reduce the positions. And so they're like in there messing around with these open trade profits at all-time highs, and trend following says, let it go. You don't have anything to do. It's a winner, so let it fluctuate. And this is not risk per se, it's volatility. Your risk was taking that small loss. And these trades that you're talking about now, they're not losers, they're huge winners. So you're in this really bumpy portfolio that has a lot of volatility, possibly, but on the good trades, when you're making money on those trades, not on the losing trades, but that's not acceptable so much to modern trend CTAs, let's say. So what I try to do then is, how do I have my cake and eat it too? How can I follow the proper trend following strategy? Proper in my mind because it's more robust. I don't have a lot of other rules and parameters that I just described. And so the best way of doing that is just to add more and more markets. So you can attempt to smooth things out more because you have this crazy diversification, stocks, bonds, currencies, commodities, long and short. And maybe that will help with this smoothness. It's not like I don't want it to be smoother. I don't want to do it at the cost that you have to pay with this heavy-handed approach of kind of money management or risk management trades. They're not really system trades. They're getting in conflict with your trend following strategy. It's not that I don't appreciate that. I understand what they're trying to do. It just comes as too big of a compromise for me in taking smaller profits and lessening the reliability of the system. So I say, okay, let's smooth things out a bit more there is no cost of adding more markets. You've heard that cliche. It is a true free lunch because we're just applying this edge to more and more markets and smoothing out the returns in the best, most acceptable way possible.
Okay. So when people ask you about why you don't set volatility targets, it's really because the cost of doing such targets goes against trend following and potentially lowers returns.
It definitely, increases commissions and trading cost, obviously. But I think really the main reason is it introduces more parameters and more rules. And we should try to desire fewer rules and fewer parameters to make the systems, this approach, more reliable in the future, more robust. And I think that that's the main reason I do it. And I don't think in the long run, it really improves things. And I just try to impress upon my clients and podcast listeners that really the risk is in taking those small losses and preserving that capital. And we have an approach that has 40% winning trades, so 60% losing trades. So it's very important to have good entries, good exits, a good stop loss, and try not to hit our capital with these losses, too frequently. We don't want to get our winning percentage too much lower than that, because it really is the Achilles heel of what we do. You take a lot of losses in a row, they're small, but they start to add up. So when we have a profitable trade, let's let that run and make an extraordinary amount of profit. This outlier trading, this hunting outliers that my friend Richard coined, let's let that pay for all of these losing trades, and let's let it pay for all these and make our profit as well, and not try to time and smooth things out that is going to reduce our profits on those really big trades. So it's a little bit of that as well. I think there is really no need to do this. And I try to convince my clients that the real risk is not in the volatility of the profitable trades. Those are profits. And we need to let those run. And really, if the computer and the back test didn't say it was superior, I really wouldn't do it. I love trend following, but if there was a loophole in trend following where I could improve it, and if this really did improvement in a real way, then I would do it in a heartbeat. But it doesn't improve it. So it affords me the ability to be this proselytizer and preacher of how wonderful trend following is, classic trend following. And at the same time, I'm right. It is much better than any of the overlays and alternatives to the classic one entry, one exit, stop loss type of trend following that really is true. You let profits run in an extreme way is superior.
What are your thoughts on the Sharpe ratio? Generally a very commonly used, metric by a lot of investors. Is it appropriate for judging a trend following strategy?
No, it's not, because it does penalize the volatility on the profitable trades. So it really just is, it encapsulates exactly what I was just saying. If you want to put one thing up as, to show how wrong that is, it would be the Sharpe ratio. You don't want to penalize the volatility on the orange juice trade. It has a big, huge trend. It's made a lot of money. It's had many spikes lower, only to go back over the last year to new highs over and over again. And somehow the Sharpe can turn that into a bad situation because somehow that was a lot of risk when it's a hugely profitable trade. So I don't like the Sharpe. Now, recently a friend of mine pointed out to me that I talk bad about the Sharpe and it's a marketing thing. Well, it's marketing in the sense that I want people to see that I do things differently than almost everyone else. And I want them to understand exactly what I'm doing. And so this explanation I'm giving you, I've given many, many times. And so trashing Sharpe is marketing in that sense, is that it behooves me for my clients to understand fully what I believe and what I'm going to do and why I believe it. But he did point out also that, adding 300 markets to trend following improves the Sharpe that Jerry criticizes. And I'm like, well, true. I don't care about the Sharpe. I didn't do it to improve the Sharpe. But inadvertently and without my control, it does improve the Sharpe. And it's the only way for me to improve my Sharpe, or even maybe, let's say, a better risk metric like rate of return divided by something. I think you don't want to use Sharpe. Maybe it's drawdown or something else I have in mind that's difficult to explain. But there's other more proper risk metrics that those would get improved as well, possibly by trading more markets. So, and everyone understands it. That trend following looks to be more, it has maybe a 0.5 Sharpe on a good day, and that this is something that is not worth paying for. It's not really that desirable, but it is not a good indication for trend following of true risk, in my opinion. And you can't penalize when I'm doing really well with my big trends and I'm hanging on to them and I'm not getting out too quickly and I'm holding on and maximizing those profits just in the way that the back test indicates that it's going to happen in the future. I should not be penalized when things are going wonderful for me. Yeah. So I could get really fired up about this Sharpe ratio thing. So sorry.
No, I love it.
But I have to laugh at all of this because it's just fun. This is part of life. I really enjoy these debates. I've had these debates with everyone, and I'm not changing their mind, and they're not changing my mind. But I think deep down they know that they blame it on the clients sometimes as well. Who are they? These different
Oh,
people. They'll blame it. Oh, well, I agree with you, Jerry, but the clients are making me do it. The clients, they don't agree. They think Sharp is wonderful. So you need to pay attention to it, mess around, screw up your trend following, add things to it that, we all know are not right, but you should do it because we're building this business here and clients demand it. And I'm sympathetic to that because you do have to build a business. It's easy for me to say all of these pie in the sky philosophical things because I already built my business, I already made my money. Men and women who are out there trying to raise a family and buy a house and get into this business and make a living, they have to make more compromises. And I understand that. But I guess secretly, when we're at the bar during a trend following conference, we are probably talking about how trend following plus nothing, which is one of my little sayings that I coined. Trend following plus nothing else, one entry, one exit, and one stop loss is going to probably be superior to everything else.
a lot of the traders I talk with, I'm always surprised because I always think I'm going to hear some fancy terms or advanced statistics, and we usually end up talking about psychology and emotions more than anything. I was wondering if you could just explain a little bit about the Coco story, the background, and explain to people why it's so hard for people emotionally or psychologically to do trend following.
Right. It is. I mean, people don't like to take small losses. They don't like infrequent profits. As humans, we want frequent positive feedback. You're doing great. You're fantastic. Just the smallest profit will scratch that itch. People want to be part of a big group that is making money or losing money. That's kind of the index people. They really have FOMO when it comes to underperforming the S&P index. And when they lose half their money, every now and then they will have a 50% drawdown. We're all losing. We're all losing. So that makes me feel better. I laugh because I think that's laughable. So there is some of that, just letting profits turn into losses, letting big profits turn into losses or small profits, just horrible. I think letting profits run, there's nothing harder for human beings, nothing. Because you have that money, you've made it, it looks like the trend is reversing. It's my money, I've made it, I can't believe you're trying to take it away from me. Grab it and I'll feel better. And the problem is it doesn't work as well as following the system, which is based upon the back test, which tells you don't get out until I tell you to get out. And that's going to be a long-term trailing stop, where you are going to have the ability to give back too much of the profit. I think that people like to do more than follow price. The world is complex. It has to be more to it than this. I've got to add something to it. I read about that all the time, about the additional things that people are thinking about when it comes to trend following, confirmation in some way. I need to make sure this breakout is a good breakout. There's no such thing as making sure it's a good breakout. You just have to do it, follow your rules. And people have a difficult time winnowing down what they're looking at. Like, look at less, not more. More information must be superior, and I think that it's not. I look at as little as possible, just these trends and nothing else. People have a difficult time. One of the things that is frustrating to me is I have friends who will talk about trading and trend following, and they'll try to make this case that it really doesn't matter how you do it. Everything is created equal. Now, then 5 minutes later, they'll say something that contradicts this, but they want to give you this impression, like if you don't like big drawdowns, then just don't take big drawdowns, and just do it your way, because you can't really follow a system if you don't like it. And if you can't follow it, what good is having a system? My reply to that is, don't be a trader. If you can't do the hard thing, If the computer tells you you're going to have these rules that are going to cause you a lot of pain and suffering, going to have volatility, drawdowns, long periods of time with no profits, long periods of time where you underperform everyone. If you can't take that and say, thank you, I embrace that, because what this means in totality is that I'm going to make a lot of money over the long term, then you shouldn't trade. That is a solution. At the end of the day, we're all winners, whether we win or lose. And I think that that sort of mentality, that any crazy idea that I might have is perfectly fine, because it doesn't really matter what you decide to do. If you want to take profits prematurely, then take them. If you want to not have a stop loss, then that's fine too. Whatever makes you feel good. I just think that's wrong-headed mentality. And I've already said, I love the way that I trade and the way that I was taught, but I'm willing to turn my back on any of it if the evidence shows me that you can do better, Jerry. And I'm all about doing better and all about improving over time. And I think that I can get better. I think there are better ways to trade. There's better ways to trend follow than I do now. And I'm on the search for them. And most people are on the search for ease, comfort, and pleasure. And this is my style, my trend following. It's wonderful. They've already told me it doesn't really matter how I handle things. This is like the most competitive business in the world. And can you think of another business where people would dare say that? It doesn't really matter how you do it. Just do it the way it makes you feel. This is not the way elite people and winners in society and famous and great traders handle things. They know it's hard and it's difficult, and they embrace it. And if I run a research or a back test and it comes back and says, oh, you can make this money and without the drawdowns and the losses, then I would immediately be skeptical and throw that in the trash. I know that's not how the world works. It may work for a short period of time. Really bad ideas and bad strategies, they have their day in the sun. They look great. The market is tempting us all the time to take the easy way out, as is life. Take the easy way out. But I want the narrow path. I want the road less chosen. I want to be alone by myself if I have to be. The only one losing money, but still believing in the right things to do.
Where do you think AI is going to take us in the future? In terms of markets, perhaps being even, reacting quicker than, for trend followers to potentially be able to use AI?
I use AI now in a way where I search for stocks and new things that are coming out in, around the world to try to further diversify my stock portfolio. So from a research point of view, which is not what you meant, but I use it, and I just don't think I'm qualified really to make too many pronouncements about AI trading in the future. I do think that I do think that it's possible for it to dominate the future and to be a useful tool for investing and eclipse trend following. I don't see how it could possibly do that, honestly, but that could be just, I can't see it. It's me, the underlying I. Jerry doesn't see it, but that doesn't really mean a great deal. I think it's quite a bit different from trend following as well, where trend followers make a lot of money on things that have never happened before. We just follow the trends. When all the markets in March of 2020 started to reverse, we just got out of our longs and went short. And we're always and when the inflation trade came about, shorting those bonds a couple of years ago, we didn't care too much about the reason. We just went short. And then as time progressed, we start uncovering all of the fundamental reasons why we're going to have higher rates and higher inflation. Whereas I think AI approaches it quite the opposite, which is we're going to learn from the past and reconfigure our rules to take into consideration all the things that have happened in the past and how the markets responded. Well, we don't look at the past in that way. And in fact, if the markets had responded in another way, in a way, and then this way, it looks like the markets are responding in the opposite way, it would be great for us because we would just go with the trend, never having really cared about history in that particular way. I just want to know historically, is buying the 100-day high and selling the 100-day low, is that profitable? And the fundamentals that drive those trends will end up playing out, of course, but I just want to get on gear with that trend and not analyze very deeply. Whereas I think AI looks at it in a different way. I've often made fun of that sort of AI machine learning in a way where I would say, yeah, I think AI should look at the history of the world and try to figure out where the markets are going based upon that history. But then the last piece of code needs to be, is the market in an uptrend or a downtrend? And make sure whatever you were planning on doing, it's going in the direction of the trend. But we'll see what happens. I'll be long gone probably before trend following is made obsolete by AI.
Stick around for a while, please, Jerry. Last week you were a guest on the ETF Think Tank, and it was a wonderful show. They asked you some really great questions. There was one part in particular that really caught my attention, and I had to think about it, and I understood it later, but I wanted to bring it up again for our guests that may would have missed the show. You were talking about correlations not being absolute, and much of your whole thing is to find outliers. So when someone had asked Jerry, why would you hold 5 oil positions instead of just one that has most of the correlation, or multiple crypto positions instead of just one that's mostly correlated? I was just wondering if you could go into that a little more in detail, because I think some people missed your point, to be honest, because they kind of went into the next question kind of fast.
Yeah, that's a really good question for me. I have to say that make sure I do a good job answering, or we can circle back, because this is a very insightful thing about the trend following that I do. And I have a handful of friends: Richard, Moritz, Mike, Mulvaney. I think he's in our camp as well. It's like 5 of us who really do old-fashioned trend following. But right, so the way I would describe that is that we have this very large portfolio, and then even if some of my friends don't trade 300 markets, they agree with trading 300 markets. So we all agree how important this is. And so in some respects, people could look at my portfolio and say, wow, no one cares about diversification more than you do. No one is as diversified as you. And maybe. I know that there's people out there that trade a CTA that trades 500 markets, but so maybe he has the ability to do that. I don't. Hopefully I will one of these days. And then my response to being the number one lover of diversification would be, well, yes and no. Yes and no. This level of diversification for me, it serves multiple functions. One is the smoothing of the returns, as I said. And then number 2 is my bet size, the amount of money that I'm willing to risk, which I'll call a bet, on every trade is super small, right? Because I have a risk budget, I divide it by 300 markets. I would probably have the same risk budget if I had 100 markets, and so every losing trade would be 3 times as large. So I'm taking really small losses, and but if you look at the portfolio closer, you'll see I trade both crudes, 2 sugars, 2 cocos. Crude, heating oil, unleaded, gas oil, and Brent are like 90% correlated. Gold, silver, platinum are 90% correlated. So I haven't gone to that step where I recognize those correlations and say, you don't want to trade them all the same size. You want to take that into consideration. And heating oil and crude are 90% correlated. And so I don't do that. So in that regard, what's going on here? I'm super intense about diversification. Obviously, it's going to smooth things out, but I'm not willing to not trade all the markets. I'm going to trade the 2 crudes. And that is because really trades, and the fact, here it comes, the fact that even two markets that are 90% correlated, sometimes one of them can have a big trade and a big trend and the other one won't at the exact same time. That has happened in my career where heating oil has doubled in price more than once, and crude just kind of sat there, didn't do very much. 1987, something similar happened in silver versus gold. So I'm really more interested in finding these outliers and being willing to trade sort of a suboptimal portfolio as it relates to diversification and correlation and smoothness, because sometimes one of these days Brent can have a really huge move and the West Texas will just sit there. And that is really the bottom line to hunting outliers is, hey, look, it has a different name on the market. If it was the same market, it would have the same name. But silver and gold are different. Platinum and gold are different. You know, when silver doubled, or silver had that big move in 87, or heating oil doubled in 1984 and 1990, they went right back to being 90% correlated with crude. And so that's what I'm willing to give up in order to take advantage of that reality that we're not predicting. We don't want to predict. We want to be as far away from predicting as possible and hard coding into your system. This is what has happened historically. I'm going to pay attention to that in the future. No, the only thing I want to do that with is these breakouts. This breakout was a good breakout historically. I'm going to hope that it's going to be a good breakout in the future. I'm going to trade multiple breakout systems to hedge my bets a bit and increase my diversification in that regard. But I am not banking on anything in the past repeating itself in the future, except that these trading rules, these simple trading rules, will continue to have similar performance as they did historically. Was that a better explanation?
I really loved it. No, I mean, it was like, I mean, I guess because the audience, the people asking the question, it's more of an obvious answer. But to non-traders or novice traders, or frankly, even a lot of less sophisticated traders, it deserved a more thorough answer. Our next question is from Tony Confletti, who's a private trader. You know, his mentor was one of the more classic systematic trend followers, and our nickname for you when we discuss you, I think you'll get a laugh out of this, is he always refers to you as the leatherback turtle. I guess that's the biggest turtle in the world, and he thinks very highly of you. He has a little more elaborate question as a professional trader, so I'll do my best to to ask it for him. He wanted me to ask you about portfolio heat, the ratio of stop out equity to portfolio equity. Do you have individual position risks between 1/10 and 0.5%, total entry below 10%? How do you manage total portfolio risk if it runs higher in strong trending markets where risk follows growth and open profits? Sorry, that was his very long-winded question. I apologize.
Right. I don't know if I can remember all of that. I think I'll just describe what I do, and then you can see if I got most of his points. So I think the most important thing for every trader from the very beginning is to understand how to formulate the risk management budget and what's your budget going to be. And so I would recommend a conservative, moderate volatility budget. And I think a lot of it boils down to, when you take a small loss, how much are you losing? And some of that is a function of the number of markets, of course. And another is a function of your overall what is your risk budget? If everything went against you with that small loss, how much would you lose? And so that is very important. And I've been in trouble, like, Rich said in the turtle class, you're going to get in trouble for two things. One is trading too large, and then not following your system. And I've definitely not followed my system before. I've definitely traded too large. And then sometimes I've not followed my system because I was trading too large and I couldn't afford to put on the next trade. I was just losing too much money. So sometimes it really does begin with how much are you going to risk per trade and what's your overall risk budget. I think another thing too that's very important is you want to set that up because primarily you don't want to have big drawdowns and you don't want to get to a situation where you're going to stop doing your trading or you're going to lose all your clients. But also, you want to set it up so you can keep doing those trades and you don't ever have to stop doing them. That is really the key to trading. Here are my rules. They're really good. I back tested them. The computer did it every single time. It never deviated. And this is what I got. I got a good performance. So you've got to do all of those trades, and you can't set up your money management where you would maybe even legitimately say, I can't do this trade, or I can't do it the same way. I have to do it smaller. You don't want to get in that situation. So really doing the trades is just unnegotiable. You've got to do it. There is nothing. If you can't do the trades, then you need to trade smaller. And then I think another mistake I think people make is they size the trades. They size the trading. The CTAs are going to size the trades based upon the current volatility, and they're going to size them using their current assets under management. And so if I lose on this trade, I'm going to lose a certain percentage of my money. And I don't think it's a good idea to use your current assets under management, especially for trend following, because those assets under management, if you start getting into a really good period, they can really start you're making lots of money. And so then your new trades are going to be bigger and bigger. And then all of a sudden that open trade profit goes away. And then those trades are too big. And so you're getting yourself into a problem here. So then you got to cut back, but you just told me not to cut back. I told you to come up with a method that doesn't force you to cut back. But yeah, you messed up by using your current AUM. You're trading too large. The current AUM is now retracing quite a bit. Those open trade profits that you were building new positions on, now they're going away. Your new positions are too large. It's just chaos. Things are falling apart. Now, when you're making money and it keeps going, you're making even more money. Good luck. But we're risk managers. We're here to figure out what can happen in the future that's unexpected and preserve this capital and not get ourselves into situations that we maybe have never even seen before. But that can definitely happen. So what I do is I trade like a discounted version of my assets under management. So maybe if you gave me $1 million to manage, maybe I would trade that at 800,000. I would discount it a bit and try to keep it constant for a while. And don't change that trade level with increases and decreases in profits all the time. At some point in time over the next year or so, we'll make a conscious decision to move it up. Maybe the account's moved up to $1.5 million now. So then maybe we'll make the trade level $1 million or something like that. I have a formula, I have a way of doing it. I'm just trying to get across the general principle of this every single day trading your assets, putting on new trades based upon current assets under management. That can spin out of control and get way too risky. And so you want to put yourself, once again, I think this is part of the question, in a situation where when these markets fluctuate because you're doing the right thing by letting profits run and you're having lots of volatility on winning trades, you're very calm because you're like, oh yeah, but it's really not playing havoc too much with my profits and with my assets. My trailing 12-month return is still profitable, and I just think there's the positives and negatives to incorporating new assets, new profits. There is such a thing as negative compounding. So you don't want to get into those situations. And so I think every CTA, every money manager in the world uses current AUM, except some of us. And I think we're all about being super conservative on the money management scheme, and at the same time looking like we're very irresponsible because we're letting profits run. But we got the back end covered because we're really conservative on our trade level. Yeah, it's hard to really explain it better than that. But
I think he's going to love your answer. Thank you.
Okay. Anything else I should add, or any other question that you want me to comment on as it relates to his question? Did I hit all?
No, I think he's going to be thrilled with that answer.
Well, he and I can have a conversation as well and discuss this one of these days. That's always fun.
Trust me, that would make his day.
Yeah.
Before I forget, there was one question on my list that I had a big star next to it, so do not forget to ask. Wanted to ask about the Blueprint Chesapeake Multi-Asset Trend ETF with the ticker symbol TFPN, which wanted to ask you more about why it was started and what is so unique about it. For you to be more public facing for retail investors in the ETF world, I found that fascinating.
Well, it is 50%. Half the markets are stocks, the other half are currency, commodity, interest rate futures. And it's unique in that sense. There's not an ETF that tries to do that. Operationally, it's difficult to combine futures and stocks into an ETF. And it's really just saying, hey, CTAs are usually thought about as crisis alpha, a small allocation to 5 or 10% allocation in your portfolio to go along with your stocks or stocks and bonds is a good idea. It helps during crisis periods in the stock market. It rubs me the wrong way, that stocks are the center of the universe. I mean, I love stocks. I trade more stocks than anyone else in this CTA community. So I obviously love them, but they're not the center of the universe. They're not better. They're not worse. I love the currencies, commodities, and interest rates just as much. I'm short stocks, long stocks, just like the other markets. And it's just not a permanent thing for me to hold stocks without wrapping trend following around it. Stocks are like all the other markets. They need a stop loss. They need a trailing stop. They need an entry, breakout entry. And I'm saying, hey, let's take all this wonderful stuff of trend following, apply it to the stocks. And so maybe we won't have as deep or as many crisis situations that need trend following. We'll take the trend following directly to the stocks, and you won't be 100% long when the market crashes, and you'll know exactly when to get back in when COVID is recovering. We're recovering from COVID. I hear all the time people saying, well, if you get out, when do you get back in? No one knows when to get back in. Well, I do. You get back in when the system tells you to get back in. So it's really just us saying, look, we're not going to play this game of everybody assuming, the CTAs even assume, because they don't want to they can't go against everyone else in the world who says, stocks and bonds are the core of your portfolio. You should long only all the time. And maybe we'll give you 5 or 10% if you're a nice boy and if you behave. And I'm like, screw that. I mean, look, trend following is wonderful. Trend following needs to be applied to stocks in the same way that it's applied to the other markets, and then not indices. The stocks, the CTAs, managed futures tends to do indices only, and that's the suboptimal way of handling your stocks. You need to have the diversification that single stocks give you, and so you can be longs and shorts, and then you'll get more outlier trades from a single stock than you will from an index.
Our mutual friend Mike had an interesting question. He had wanted me to ask, are there any commodity markets that you can only access via equity exposure?
Well, with all due respect, that person has been reading my Twitter because I made that point recently, and yes, there are. Some of them are pretty easy, like coal, lithium, uranium.
I was just thinking uranium, yes.
Yeah, there's actually a spot uranium um, trust that holds uranium. So, and then I think it's probably less direct. I have a tendency to invest in a lot of miners, a lot of any company that's related to the food process. Food and mining, shipping would be one. Um, I definitely would prefer corn, the corn future, to maybe a company that does something in corn. You're going to get the pure corn move, and companies that do something in corn or copper, they're also doing something in gold and silver and other metals as well. So it's not that pure trend that you would get from the future itself, but it's different. And it's diversification. And if you own a copper miner or a gold miner, it could be a little bit different from gold itself. Sometimes, well, I think in lumber, lumber is an illiquid futures market, but some of the lumber companies had that same big move that lumber had a couple of years ago, but they didn't have quite the sell-off. And so sometimes the company that's associated with a certain commodity, even if it exists in the futures markets, it might be a better trend, or at least a trend that'll give you some diversification. It's not just ipso facto; it's inferior. I hear that a lot from people who don't trade commodity stocks. Of course, they're trying to make this point, and I agree, it's not the same thing. And sometimes that's thankful. Sometimes it's better. Sometimes it's worse. Just like I would say sometimes aluminum is going to be better than copper, zinc, nickel, lead, and tin. One of those 5 or 6 are going to be better than the others. In the same way, a commodity related stock can be better than the commodity itself. But I think the key is to be able to find stocks like that, and commodity stocks in particular, that offer true diversification to the portfolio. And that's what I'm after. And that's why I trade stocks. And I make stocks 50% because they deserve to be 50%. It's not a marketing scheme. There's thousands of stocks. If there was thousands of commodities or interest rates or thousands of currencies, that particular sector would be 50%. But with 50 some commodities and 50, 60 currencies and maybe 40 possible interest rate futures, they're not giving me, that sector is not giving me the diversification that I can get from hunting amongst the thousands of stocks that are out there that are liquid, that would be good candidates for a diversified portfolio that is seeking outlier trades. Then I can just find so much more diversification in that stock sector. Recently we've been short every single bond market on the planet, only short. There's no longs. Prior to that, I'd say a couple of years ago, we were long the dollar. Almost every currency was short the dollar. No diversification there. Now we get quite a bit of diversification in the stocks. We're about 50% long, 50% short now, and we have stocks that are in uptrends and a lot of stocks that are in downtrends, and we're taking advantage of that. And that's the true signal of diversification. Do you have longs and shorts in that same sector? Sometimes you don't. Sometimes you can't, and that'll happen in stocks as well. But usually I think stocks are going to give us a really good opportunity to increase the diversification. And because of that, they deserve to have a hefty part of the portfolio. But for only that reason, we don't ever do a back test to see what the best performers have been. You mentioned Coco earlier, and we traded Coco, and it probably didn't have a good trend in 10 years. And we not only did we trade it, we added London Coco. We said double up. let's double up on the pain whenever we get a chance. It's really it can really be a sad story sometimes. Like, why are you doing this? We're like, well, we firmly believe in the philosophy that these markets are not bad markets. They just haven't had a trend. And you don't know when they're going to have this good trend. History is not a guide for that particular question. We trade all kinds of markets that have not had profits recently and that maybe have almost never had very many trends, but you never know. The world changes, and that's what we're here for, is to take advantage of when the world changes and people get too smart and too analytical. We're on the surface. Uptrend we're in, downtrend we're short, and let's just see what happens.
Definitely classic trend following. Yes.
Classic trend following. Yep.
For the people who want to follow you more frequently, is Twitter the best place? It seems that's your favorite of the social media platforms.
I like Twitter. I try to make myself like LinkedIn. Um, it's okay. It's just Twitter's pretty easier for me to understand and to use. I do a Twitter Spaces, which is like a live broadcast podcast every Friday at 7 a.m. Eastern time. That's fun. You guys should be on there. I know time zone, it's not that easy for people, but we have people all over the world: Russia, Italy, Australia, US, Canada, everywhere, tuning in at 7 a.m. Eastern time on Friday morning. Spaces, trend following Spaces. That's good. Twitter's good. My direct messages are open on Twitter, and I have a tendency to have email conversations with people I don't even know, or heck, I even went to France recently, and one of my Twitter followers, who's I perceive to be a nice guy and someone I should not be afraid of, he and I met up. He's from Romania, and he and I met up in France. He took a flight to France, and we had lunch together.
No way.
We had just to chat, and I've done it a couple of times. 4 or 5 times. I can't ever remember not doing it when people have asked me to do it. And my wife is like, we land in France, and she goes, "What are we doing for lunch?" I'm like, "Well, we're going to meet this guy I don't even know from Romania." She's like, "What are you doing?" I'm like, "I think it's going to go pretty well," and it did. We had a really good time, obviously, and so. Yeah, but I would also say the podcasting, I'm out there on podcasts every now and then, like this one, and I post them on Twitter and LinkedIn. So yeah, those are fun, and they're kind of interesting, and it's really nice for people like you, to listen to the podcast and to take them seriously and enjoy them, and then follow up with questions, because when I get finished with those things, I'm like, yeah, I didn't do a good job. Wasn't that clear? I wonder how it came across. I'm trying to be funny. I'm trying to be light. And then all of a sudden I get very intense about vol targeting, vol management, and trading stocks or not trading stocks, So then I try to get back into being more of a nicer sounding person. But I get in trouble sometimes because I'll start a concept, I'll start a thought, and then I'll forget. I don't end it well. I forget about it. I get distracted. So thanks for asking me questions related to previous podcast.
Well, thank you. I just really appreciate all your time, Jerry. And thanks. This has been just an absolute pleasure. Is there anything else you'd like to, relate to listeners and, people trying to understand trend following?
Oh, I'd say you did a really good job, and you allowed me to go off on tangents, and I remembered a lot of things that I thought was important. I like to re-listen to podcasts over and over, so I encourage people that the second or third time through, if you found it interesting, the ones I find interesting, I can just listen to them multiple times and take notes and learn more and write down questions. But anything to do with Richard Brennan, he's on. He's my friend on the Spaces and on Twitter. He's a super smart guy. I mean, he has just helped me see trend following in a deeper light as well. So Richard Brennan is another. He has his own podcast, Algorithmic Advantage, on Spotify and YouTube. So he's really great. search out more podcasts from people like that. Moritz Seibert, he's really good. He's starting a new podcast soon. He's done a lot of podcasts as well. He's on Twitter. He's easy to find. Those two guys are really great at classic trend following, super smart, very interesting, funny, as I was almost say as well, but I guess that's up to you guys if I'm really that funny. But yeah, so that's what I do. I listen to a lot of podcasts and try to keep up with my favorite people on Twitter, and I'm always learning something too. So I'm a lifelong learner. Hopefully, you can always uncover some more ways of looking at things.
I just wanted to thank you again. Thanks so much. It's really been a pleasure, Jerry.